Hello and welcome to SwitzerTV. I'm Peter Switzer. Thanks for joining us. On the program tonight, we have Jun Bei Liu of Tribeca Alpha Plus, and I've got to look at three interesting stocks that the analysts like. And the market kind of is mistreating them. You've got Santos on one hand, you've got Pilbara Resources, and an interesting company called Dicker Data. Dicker Data in particular, one analyst thinks it has got 57% upside. And interestingly, they reported today, and the CEO of Dicker Data, Dave Dicker, is actually joining me on the program tonight. This is a really interesting company. I'm not saying that necessarily is going to do really well in the future, but gee, it has done well in the past, as I will show you in my interview. And then we have the CFO of BHP, David Lamont. He talks to my colleague Paul Rickard about the BHP result, and most of us want to know, where is this company going and what's going to happen to the dividend? They did cut the dividend last week, but is there a chance that it might come back? We might find out when Paul Rickard talks to David Lamont. That's the show. Let's kick off now with Jun Bei Liu. Well, joining me now is Jun Bei Liu of Tribeca Alpha Plus. And I want to see how she's looking at reporting season and a number of stocks I'd like her to run her eye over. Great to see you, Jun Bei Liu.
Great to see you, Peter. Thank you for having me.
Okay, so for the Switzer report today, I talked about three stocks that the analysts like, but the market has been really tough on them of late. And the first one is Santos. What's going on with Santos? So every analyst on FN Arena likes the company, but the market doesn't seem to want to like it. What do you think's going on there? And do you like it?
Yeah, look, I like it, and that's the issue. Market seems to like the Woodside a lot more than the Santos. I think there's a couple of reasons. One is they have had a few production disappointments, and Santos was the natural holding position for energy exposure for a lot of big investors. So they're already holding the stock, and things a bit disappointing. So if anything, they've been selling. So that's been the challenge. And Woodside is the new merged big company on the block, and they had just seen, as a result, a lot of natural flow from Santos into Woodside. I like Santos. It's very good value. It's underperformed given where the oil price is, and I think it's some of its troubles sort of way past it. Looking ahead, it certainly looks a lot cheaper compared to the likes of Woodside. It's implied oil price based on the current current share price is actually currently 10% below what the Brent price is. So it does give you quite a bit of upside at this stage. And I do think with the China sort of reopening, gathering momentum in the next few months, the oil is pretty well positioned.
It seems to me also with Chris Bowen coming out and saying that natural gas is going to have a role in the transition to renewables, it kind of should be good news for a company like Santos. And the share price did go up by 1% on Friday when Bowen said that. I don't know what's happened today.
Yeah, look, today is down a little bit. Today is a sort of a down day across the market. Just seeing the investor taking a bit of risk off, with the interest rate expectation now going higher again. So look, my view is that yes, because we have seen what happened with the energy shortage. We have seen what happened to the energy spike. So energy price spike in the last 12 months. So it's only natural for a company like Santos to really participate as part of this transition. Because there's less and less newer reserve to be explored because of this transition. I think it's well positioned, and given it's lagged behind its peers, it does look very good value.
About PLS, Pilbara, the lithium story is not easy to work out. We know lots of electric vehicles and lots of battery demands out there waiting to happen, but we don't know what the supply of lithium is going to be like in the future. What's your take on A, lithium, and B, Pilbara?
Yeah, look, my view of the lithium is that, the fall of the spot prices is bound to come, still way ahead on a 2-year basis. Now it's coming off because of a little bit of demand weakness, and of course it rallied too hard in the last 12 months. I do think it's probably finding a bottom somewhere around here. With China reopening, you will have and continue support in terms of the EV vehicle, in terms of subsidy. I do think that demand is coming back. Share price, well, not share price, the actual lithium price is probably stabilizing somewhere here. Now, PLS is probably the most pure exposure to that lithium prices. It's recently had a good result and has done a good deal to really de-risk some of its production. Although at a lower prices, but it's in short, incredible amount of cash flow is coming back to the shareholder. So my views, I'm reasonably neutral at this point with the lithium. You do need to see China coming back full stream, and also globally in terms of Europe, it's not falling off too quickly. But if you're going to buy a lithium stock, I think PLS is a very good exposure. It now has generating incredible amount of cash flow, and it's paying dividend.
Well, I noticed was that Macquarie is a big fan of PLS with a big target price, while I think Credit Suisse is another big supporter with quite a big fall in price. So it's a real split situation for the company.
I think it all comes down to, it's actually not to do with the company. It's all come down to the outlook for the lithium prices. So if one of them is very negative with lithium prices in 3 years' time, normally in the next couple of years, prices are somewhat similar, but it's really 3-4 years horizon. The price varies significantly, so it really changes your valuation.
And I've never asked you about this company, Data, but when you look at its long-term share price, it's been a very good performer. It has fallen about 40% this year, along with tech stocks, but its CEO, Dave Dicker, said we're not really a tech company, but though they sell technical type products. Have you ever run your eye over Data?
Yeah, look, we had a look at from time to time. Yeah, for a short period, maybe 12 months ago, we have been shareholders briefly. Look, this company has been impacted previously by the COVID disruptions and things, and has gradually recovered from that. But the gradual recovery has been quite disappointing in the last 12 months, just a little bit slower than expected. And then now it's sort of on the way back. I thought the result was pretty good, so just recovery taking a little bit longer. It's not expensive. It's a company kind of it generates that kind of high single-digit growth, reasonably defensive when it returns to normal. The challenge is because it's a very small cap, and it currently in that part of the market really, there's lack of appetite, for new investors into that space. I guess it's just one of those stocks sort of fallen through the cracks at this point.
And it's interesting. I know for a number of my financial planning clients, I've talked to them about maybe positioning ourselves for future 12 months or so when the big caps that are all being loved now, there's a rotation out of them and they start chasing smaller cap companies. Do you see that being a likely scenario for the market, say in 12 months' time, that tech and small cap companies will be chased and people will take their profit in the big caps have done so well over the last couple of years?
Oh, absolutely. And I think it's sooner than 12 months. I think it's in the second half of this calendar year, you should see that taking place. Right now, market is really still going through its rebasing of the earnings expectations. So, that there's a bit of, flight to quality and people staying defensives. Once that takes place in the next 3 to 4 months, you should really see things rallying from there. And then it's the big cap, it's the healthcare that will be used as funding for some of those, high growth companies.
Were you laughing at me being conservative? Because I totally agree with you. I think it will come earlier. I think as soon as we think the Fed is no longer going to raise interest rates, it'll be a good time to be chasing tech and small cap.
I reckon your buying is between now and the next 3 months is your buying opportunity, because the risk is really coming out now, and this is when you actually see some of the really bottoming prices in some of those sectors.
Before you go, you've been looking at a whole lot of companies reporting. Has there been a standout company that you've liked what you've seen and you're prepared to put your great reputation behind that company.
Oh, absolutely. And then this reporting season was quite interesting that some of the results were pretty good and the share price sort of, fallen away. And this is, in my opinion, this is your opportunity to be buying more of it. First one is A2. The result was incredible. China delivered over 40% growth and and then that reopening thematic in China is really gathering momentum for that business. Market was a bit disappointed because they're guiding to, Australian English label is not as strong. Well, that's because the borders yet to open, student yet to return to drive that Daigou channel. But we know that's coming. We already got directives from Chinese government for students to be traveling. We see that as it was a very strong result, still very strong balance sheet. And the US doing a little bit better and China is incredibly strong. I think, it really provides a really good buying opportunity post that result, just showing the continuation of earnings recovery. And another one is like Treasury Wine. There's another example of market is sort of becoming quite impatient. Company, grew they grew close to 20%, and they got it to 17% growth for the next 12 months. And market was disappointed because it wasn't 20. In my view, that this is, it was quite unfair to be punished by, with the earnings expectation, despite the slowdown around the world, is still in that double, high teens level. With there's another prospect of China tariff being changed somewhat, and to me this is a very good buying opportunity.
So two very liquid stocks there in A2 and Treasury Wine Estates. Jun Bei Liu, thanks for joining us.
Thank you very much.
Thanks for joining us, Dave.
Yeah, no problem.
All right, mate, you reported today total revenue for the 6 months was up 6.3%. You've maintained a strong revenue growth. Gross profit increased by 3.3%, 99.6 million gross margin. Why is the share price down today?
Well, we didn't quite do as well on the NPAT side as we hoped we would, and a lot of people didn't like it, I guess. I mean, honestly, look, one of the things with this whole thing that I find extremely aggravating is that we have no control over interest rates, and neither does any other business in Australia outside of the banks. We don't have any way to source money at lower interest rates. We can't do a thing about it. So if interest rates go up, you're going to make less money. That's just as simple as that. And not just us, every business, because all businesses borrow money one way or the other. So it just seems crazy that it's like, oh, you've taken an interest rate haircut, so we're going to mark it down. They'll be marking everyone down.
How far out was the NPAT?
Well, it was out a fair way. I mean, but the like I said, there was basically two components. The interest rates rises were about half of it, and inflation related things like wage increases and other things added to it as well. And as I said, we don't control those things. And let's face it, if the interest rates went up too high, no one's going to make any money. And that's just the way it is.
Yeah. From my point of view, Dave, I don't care so much about the past, apart from the fact that can we use that to take a view on where this company might go. How important is, say, a rising Aussie dollar to your costs?
Well, it doesn't help, obviously. But to be honest,
if the Aussie dollar went up, your costs would go down, wouldn't it?
Well, if the Australian dollar improves against the US dollar, vendors will buy cheaper and they'll have some room to maybe lower costs. But really, it won't really make a lot of difference. It's a competitive industry, and the vendors are as competitive against each other as we are against our competitors. And if their base buy price goes down, they'll lower their prices, just as if their base buy price goes up, they'll have to raise their prices. So I don't see that the AU to USD is really pivotal here.
Now, I'm going to put on screen a chart of your long-term performance, which is a very impressive chart, except for the last year when your share price has gone down. Do you think you've been judged as being a tech company? Because tech companies have copped it this year. Do you think the sell-off for your share price was related to the fact that tech companies have been treated badly by the market?
Well, it seems like it, but I'll be honest, I'm not sure I should complain real hard, because when our share price was much higher a while ago, we were considered a tech company. And I used to tell people, well, we're not really. So look, the share prices can be irritating, but our focus is getting the result with the company. Look, even though we didn't quite make as much money last year as we wanted to, we made about basically the same as we'd made the year before, and we got a substantial increase in sales. So that's a platform to get a better outcome this year. So and I've had a few abusive emails as well from disgruntled investor guys. And honestly, I find it kind of amusing, because look, we listed this thing at 20 cents a share, and even at $8, it's still like, it's what's wrong with these people?
The whinger probably bought you at the top, and they're whingers. But the bottom line, I think, is Morgan Stanley thinks you're scheduled for a 57% rise in share price. Ord Minnett says a 38% rise in share price. I guess you're quite happy for them to say that. How is that going to come about? If they're right, Dave, how is that kind of improvement in the company performance to justify the kind of target share prices they've got for the company? What has to go right over the next 12 months?
Well, I'll be honest, I don't know if the share price is correlated to the company's performance in almost any way. That's the way shares are, because we're currently, I think our PE is 18 at the moment, and it was a year or two ago, it was close to 40. We're basically the same company with the same level of performance. And one of the things that people lose sight of is, for instance, our sales per head metric, which has always been a very important metric to me, hasn't really moved in the last 10 years or more. Yet we've got over 600 people working for us, and we used to have, like a third or a quarter of that number. So we've been able to scale the business up, and even in terms of sales, we've been able to scale the business up massively without actually increasing the base costing of doing that. And very few companies are going to do that.
I think the fair comment is what the market thinks a company's worth is a matter of judgment, and doesn't mean they're right. 2 years ago, CBA was $58, and today it's 110 or whatever. So I guess the issue I care about is, what do you, like for example, if interest rates fell from the end of this year rolling into 2024, would that have a significant impact on your net profit?
Well, it depends where they fell to, but it would make a substantial change, yeah. Because look, interest rates are a cost of business. We basically run the business on borrowed money. That's our model. So of course, if the interest rates go up, you will lose less money. You will make less money, and you can't do anything about that. Just one of those things.
Yeah, but on that,
I got to admit that I'm a little bit puzzled as to why the economists and the governments think that the best way to fight inflation is to raise interest rates, because they're basically hurting the economy. And how rational is that really? I think there'd be better mechanisms to get that outcome if they were really that concerned about it, personally.
I think economists do debate that themselves. But unfortunately, we're stuck with it, Dave, and ultimately you're stuck with it, and so are we as investors. Mate, what percentage, have you been able to work out what percentage your Dicadata's got for the market that you play in?
Oh, well, all that data's in our annual report. I don't have all those figures off the top of my head, but we do go exceptionally well compared to our competitors. I mean, we're the leading commercial distributor.
So, is there any new strategy that you're going to bring to market that could have an impact on that market share that you've got?
Well, obviously, after last year's outcome, I wasn't very happy. So we're very strongly focused this year in making sure that that doesn't happen again. We made a mistake in the way that we did the dividends, which is okay, because sometimes we make mistakes. We had the best of intention on it, but we won't operate the same policy on how the dividends were priced as we did last year. And I think that'll get us back into a better position. The company itself is in fantastic shape. I mean, we're extending our warehouse because we're doing more business, and operationally it's working exceptionally well. And we've still got some very good upside with the Hills side and with the New Zealand side. So I remain completely confident. To be honest, the shares are a bargain at the moment.
Dave, were you impacted cost-wise by the implications of the Chinese, pandemic lockdowns, the supply chain problems we hear about? Was the company and its cost affected by that? And I guess the next part of the question is, if China's reopening, is that going to have a potential improvement in the costs coming out of the supply chain?
Well, I think the issue was more availability than cost. Let's face it, it doesn't matter what the cost of something is. If you can't get one, you're screwed. That will obviously improve.
Yeah.
So once the supply chains get back to the sort of equilibrium we've had in the past, then that'll make for a better situation.
To recap, for people who didn't follow the situation with dividends, what mistake do you think you made with dividends?
Well, what we've always done in the past, that we pay 4 dividends a year, and we would do the first 3 dividends at a relatively conservative rate, and then the final dividend would be a top-up rate, which would often be a lot higher than those 3 previous ones. So in the interest of smoothing things out and maybe trying to be more transparent with the market, we tried to adjust them so that the 4 of them would have probably ended up the same. And because the conditions deteriorated in terms of the interest rate side especially, and also the inflation side, we just couldn't make that number in the last quarter. And of course, all the investors and analysts have arced up over it, which is, we paid 0.5% less in dividends last year operationally than we did the year before. I don't think that's a tragedy.
Does the rough yield work out for the dividend?
Well, it really depends on where your PE is. At the moment, the yield would be above 5%, and that's a frank yield. In the past, it would have been, before the interest rates started to move up, it would have been pretty much half that.
What is the likely direction of this dividend? You said you sort of mucked up the timing of it, but what's the likely quantum of the dividend going forward?
Well, it'll be more than it was last year. I mean, that's all I can say. Look, it's very difficult. We normally give guidance, but I'm not sure that we will, because the conditions are just too volatile.
If we're looking at a slowdown of the economy in the first half and maybe a pickup in the second half, would that ultimately be good news for the dividend?
Yeah, for sure. I'm not nearly as convinced that the economy's going into a recession or that it will dip sharply. I find that fairly unconvincing an argument.
And is that partly based on the kind of demand you're seeing from customers at this point in time?
Yeah, look, we're still in a strong position, and our industry's always been pretty recession resilient, and I don't think that's really going to change. And I still feel that the overall economy is stronger than people realise. Look, the whole COVID lockdown proved that the economy had more resilience than I think people would have said it would have had.
Dave, I did talk about Dicker data in the Switzer report today for our subscribers, and I totally left out the idea that you actually pay a reasonable dividend. I've got to apologise to you for that.
That's okay.
Going forward. So if someone was thinking about the company, and clearly you are telling us that you believe the market is not really effectively pricing in what you see in the future, what do you think is the strongest argument that Dicker data can resume the kind of resilience in share price that was shown in the chart that I've put on screen already?
Well, I think the main thing to do is compare the actual results of the company to other results from other companies, and then look at the relative PEs and see where you're at. I mean, Data 3 is a good example of that.
Yes, and I look forward to watching the progress of your company.
Thanks very much. Thanks for your time.
That's Dave Dicker, CEO, founder of Dicker Data.
Joining me now is David Lamont. He's the Chief Financial Officer from BHP. David, welcome to the program.
Good to be with you.
Look, at a headline level, a lot of so-called negatives in the sense of at least a lot of things down. So revenue down 16%, EBITDA down 28%, EBIT down 31%, profit down 32% to $6.6 billion, dividend down 40% to 90 US cents per share. A little bit lower than the market was expecting. I just wonder what your assessment or BHP's assessment of the result is.
Yeah, certainly from our standpoint, we think that the dividend that we paid out of 90 cents per share US, which is the 5th highest dividend that we've ever paid, is representative of the underlying performance of the business. So if you look at the production outputs that we had, we did see that iron ore had a record output. We also had a 12% growth in our overall copper portfolio and 5% growth in our BMA coal assets. Now, against that was certainly price declines. So we saw a 25% decline in iron ore prices, 19% decline in our copper portfolio, and a 3% decline in our hard coking coal. So that's what flowed through to the overall result. But the things that we can control, the operational performance, we're very comfortable with.
Okay, so you mentioned about price declines because EBITDA was down from $18 billion down to 13.5, and 3.9 of that was commodity prices, and another $0.4 billion was due to FX movement. So the bits at the cost side was about $1.2 billion, and you talked about inflation in your result. Could you just tell me what sort of how BHP is looking at this cost base and what you're doing in terms of trying to manage the cost down?
Yeah, so we have a continuous focus on our cost portfolio as such. Let me start by actually saying we always said that there was going to be some lag effects of inflation throwing through the economy as such and into us. We're not immune from that. What we did see is that the underlying inflationary aspect was $1 billion of a hit to our EBITDA, and that reflects an underlying inflation number of about 12%. One of the key outstanding aspects of that was actually in diesel prices, where we saw the diesel price was up some 70%. And what that's actually meant that of our overall cash costs, diesel's gone from what was 5% of our overall base to now 8%. Now, encouragingly, as we look forward, we think we've probably seen the peak of diesel prices. And so the second half of the year, we should see some further relief.
Okay, let's talk about near-term growth opportunities. You've mentioned two. One, of course, is increasing production out of the West Australian iron ore, and I think the target now is to get somewhere over 300 million tonnes per annum. How's that going, and when are we likely to see some of the debottlenecking, I think, that you referred to, or the company refers to?
Yeah, so just to put that into perspective, currently around about 290 million tonnes out of our iron ore business, and we continue to squeeze the lemon and look to see how we can optimise the supply chain. And we can see our way forward to in excess of 300 as a result of that activity. What we've also then said that we're looking to do is a study to see how we could go from 300 to 330. Now, that will require some further capital. It'll require some further investment at the port to actually make that take some pressure off the port side of things. Potentially that might be a sixth car dumper that we need into that capacity, and that will be the capital, which we're continuing to study, as I said. But we're very encouraged by the overall growth portfolio that we have. So on iron ore, as we said, 290 to 330. We've also got our Jansen project coming on board, which is getting us into that new commodity for potash, which we see has been very critical to supply the world's food needs with fertiliser as such. And we continue to look at what we can do in our copper portfolio as well. And we see that we have great opportunities alongside that.
Go back to the Jansen, the potash. I mean, that's been an asset now that BHP's had on its books for a long time, and you've been, I think stage one is partly underway. When are shareholders likely to see, when is BHP likely to see the first return out of the Jansen project?
Yeah, so when we sanctioned Jansen Stage 1, we said that we'd be likely to be into the market in 2027. What we've reported this time around is we've been able to pull that forward to 2026. So first, commercial product would be into the market in 2026. What we've also indicated is that we're pulling forward our Stage 2 study and looking at creating further options for us to grow our potash business. Now, that is a study at the moment. We'll need to see how that plays out. And when we may ultimately look to execute that, but it's an option that we're very much encouraged by.
December, you announced the purchase subject to a scheme of arrangement for Oz Minerals, paying I think almost $10 billion US, $28.25 a share. How does that fit into the portfolio, and does that give you some opportunities to leverage? Are there any cost opportunities in terms of how that's put together with your existing copper assets?
Yeah, so let me start by saying this is still subject to obviously a vote by the Oz Minerals shareholders. And just for clarity, it would be 9.8 billion Australian dollars. So if you take today's exchange rate, it's probably back down to around about 7 US. It is still
right throughout this, right? So yeah.
That's all right. It's still subject, as I said, to ultimately a shareholder vote by the Oz Minerals shareholders. We expect that to be in April. And if that all goes to plan, we would see the asset coming into the BHP family in May, early May of this year. We see that as a great opportunity to further consolidate our position in the South Australian copper basin. As you know, we already have Olympic Dam there. As part of the results, we actually also gave some more details in relation to Oak Dam and the 40 kilometres of drilling that we've actually done on that opportunity. So all of that will come into the mix. We'll look at how do we embed the great assets that Oz Minerals have and also the people that exist within Oz Minerals. We'll look to learn from them as well and see how that can actually add to our overall growth portfolio, not only in the South Australian copper side of things, but also in our nickel portfolio in Western Australia with their West Musgrave opportunity.
Now let's move on to your coking coal assets, particularly in Queensland, because you've sort of taken rid of the stick to the Queensland government over their royalty charge. You've said that they're not going to put any more sustaining capital into BMA, and potentially you might be looking to sell some of the Queensland assets. So I just want to sort of put a bit of colour around how that is playing out in terms of how you are looking at the royalty charge and what it means in terms of how you run those mines going forward.
Yeah, so let me start that what we've announced today is very much on strategy. We've always said that steel making is going to be important to help the world decarbonise. And in order to do that in the most efficient way, hard coking coal will be the source product that we believe going into blast furnaces. And that leads us to the profile that we want for the BMA assets. So the two assets that we've actually announced today that we're looking to sell will further move us up the premium curve in relation to our portfolio on hard coking coal. Now, importantly, what we have said is that we'll continue to maintain the operation, still drive for productivity in the operation, but there'll be no growth capital going in there. And that is fundamentally on the back of, as you mentioned, the Queensland government's position. You know, for us, what we need is to be able to balance risk and certainty. And when you actually are in this business, our assets are long life, require long amounts of capital. We need to actually have reliability on the underlying physical regime that actually exists. And we think the Queensland government's royalty has changed that risk profile, and we aren't looking to further invest in growth into the BMA assets.
Let's go and turn on to your guidance, because you've maintained production guidance and said that perhaps some additional costs, particularly in the energy coal business. You want to just talk through the changes you've made to guidance on the cost side?
So we haven't changed our guidance in relation to both medium-term guidance or the guidance for this year from January when we updated the market. So at this stage, we're very much focused on what we can do to continue to drive cost efficiency across the business. I will just reference here as one example, you know, Western Australian Iron Ore, which is our biggest producing asset, saw C1 cash costs increase only 5%. And what that's enabled us to do is continue to create a competitive advantage versus our nearest peers in relation to our overall cost position. We are the lowest cost iron ore global producer.
Talk about then finally something that you can't control, which is commodity prices, but obviously in terms of how the BHP shares trade and in the short to medium term, commodity prices have a huge impact on the share price. Just wondering what's your sort of view. I mean, you're very close to the steel manufacturers in China and India and other users of the commodities. I mean, what's your sort of the company's view about both the near and the medium term outlook for some of these commodities?
Yeah, so certainly when you look at China and India, we think they will be a source of stability into the global economy. Now, contrast that with perhaps the aspects you're seeing in the US and also over in Europe, which we see at this stage, you know, will they move into recession or not? But offsetting that is the stability that we see in China and India. We're seeing some good early signs and green shoots in China post the Chinese New Year with the COVID restrictions relaxing. We're seeing that certainly play out in relation to new loan rates. We're seeing that in relation to the real estate sector and new starts, on top of the completion of those that have already been put in place. So the Chinese government has stepped out and actually supported the residential development and builders, and we see that as a positive aspect. Equally, have a look at what's happening in China. We see ongoing steel demand there, and that plays well for our overall position.
Okay. Well, look, finally, just to, and we talk about sort of so-called future-facing commodities, a lot of discussion, I guess, around copper, but also around nickel. So what's sort of BHP doing in terms of nickel, and where do you see that sort of, could that potentially be a fifth or sixth element of your core portfolio?
Yeah, so certainly we have it as one of our key five core commodities that we're looking at. We think if you look forward the next 30 years versus the historical 30-year period, that 4 times the amount of nickel will be required in the globe to actually feed into the electrification that's playing out. Now, a lot of that's EVs as such, and we see that what we have in Nickel West is the second largest nickel sulfide resource in the world. So we're looking to see how we can harness that. Back to the Oz Minerals transaction as well, if that actually completes, we'll also pick up their West Musgrave project, and that'll feed into our overall thinking in relation to nickel. But we see nickel has been very positive moving forward.
Well, David, congratulations on the result. I think, as is pointed out, I think it's your second highest December half year. I think not a record, but you can't control commodity prices, and it sounds like you're a little more upbeat in terms of the immediate future. Shareholders will certainly enjoy the 90 US cent dividend. I think that's about $1.30 Australian that'll translate to, and congratulations. Thanks for joining us on Switzer.
Pleasure. Thanks very much.
And that's the show. Thanks for joining us. Remember, if you want to become a subscriber, go to the Switzer Report, switzerreport.com.au. Eventually, we're going to put this behind a paywall and only the subscribers will see it. But for the moment, we're doing it for free, but it won't last forever. Thanks for joining us. See you next week.